Hello, I'm Curt Long, Vice President of Data and Research and Chief Economist for America's Credit Unions. The housing market is still strained. Prices are high, rates are above 6%, and affordability remains a concern. Let's take a dive into the current state of the housing market and what could unfold this year. There's plenty of debate these days about macroeconomic conditions, and there are many contradictions. The job market seems a bit soft, but unemployment is still low. Consumer sentiment is poor, but households are still spending. One of the few places in the economy that we can speak about definitively is housing, and the picture there is not good. Sales activity is down about 20% since 2019. Construction activity is declining, and employment growth in the home building sector has been flat over the past year. Put simply, the housing sector is in a recession. As we'll see, a lot of the current weaknesses can be traced back to the overheated housing market right after the pandemic. Let's first look at what's happening with apartments, since the rental market interacts with the home purchase market in important ways. Multifamily construction surged in 2020 and 2021 due to low rates and stimulus-fueled demand. That new supply came online in recent years. Completed apartment units have begun to normalize, but that post-COVID glut is still having a big impact. Vacancy rates are elevated, and renters have more options and more leverage when they negotiate new leases. We see a clear and dramatic impact of that excess supply when we look at median apartment prices. There was a sharp increase in rental rates, along with everything else, in 2021 and early 2022. But since mid-2022, there's been deflation in apartment rents. This provides a cheap alternative to would-be homebuyers. When renters survey the market for single-family homes, they can afford to be patient and wait out sellers who may be pricing their homes too aggressively. As a result, we've seen a large share of listed homes that are either getting delisted or offering price cuts. Turning now to the home purchase market, we start with home buying sentiment. It is historically low. Buyers soured on the market starting in 2021 when sellers were fielding multiple offers well above the list price. As we'll see in a moment, price growth has moderated, but today's buyers are discouraged by rates more than by prices. The combination of rapid price appreciation in 2021 and the surge in mortgage rates in 2022 from 3 to 6% crushed affordability. Housing costs above 30% of a household's income are generally considered to be unaffordable. Here we see what a typical new home would cost for the median household, and it's well above 30%, a far cry from where we were entering the pandemic. More recently, we have started to see some improvement in conditions as price growth and mortgage rates have moderated. But it will still take some time before we see a level of affordability that will draw a lot of those would-be homebuyers off the sideline, especially when they have viable options in the rental market. This chart shows home price growth over the past year for the U.S. and the 10 largest markets. Focusing first on the U.S., we see the story is that price growth has been flat over the past year. If you look at a narrower window, say the past 6 months, we do see a mild decline in prices at the national level. But another interesting thing we see right now is a lot of regional variation. The big construction surge that we talked about earlier was primarily located in the Sun Belt, places like Florida and Texas in particular, and in Southern California. The Northeast and Midwest did not see the same level of new supply, and as a result, they're seeing sturdier price growth today. Finally, we look at outstanding mortgage rates for current borrowers. As you probably know, a big challenge for the housing market has been the lock-in effect of low rates. Homeowners with 3 or 4% mortgages who might otherwise be looking to trade up are staying put because they don't want to increase their financing costs. And while we still see a strong and consistent share of outstanding loans at 3% or below, the share between 3 and 4% is starting to recede. On the other end, the share of mortgages at 6% or greater is rising. It's possible this dynamic could provide some thawing of the lock-in effect. That would help generate more sales activity. But it's important to keep in mind that those households with 6% mortgages have not seen much price appreciation in recent years. So, they likely don't have much equity at this point. But even if credit unions do not see much improvement in purchase loan demand in 2026, there is at least an outside chance that refinance activity could improve in a meaningful way. We would probably need to see rates decline to the low 5s for that to happen. Now, I'm not overly optimistic that we'll get that in 2026, but it is at least a possibility. That will do it for this month's economic update. We'll see you next time.